There are many profitable ETFs or exchange-traded funds, but which ones are best for your portfolio depends on many factors. Generally, the older and closer to retirement you are, the more a conservative investing style is necessary. Those nearing retirement should focus on income and capital preservation instead of trying to earn higher returns through a growth strategy. Designing a well-balanced portfolio doesn't require much effort, and once established, can be left alone for many years. In fact, a healthy portfolio doesn't need to be more than just a few different products. These are the best funds in which to invest depending on your age, starting with the funds that are best for younger investors and progressing through each age group. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. VUG Vanguard Growth ETF is a perfect fund for those in their 20s and 30s who are many years away from retirement and who have time for their investments to recover from more significant downturns. As the saying goes, higher risk, higher reward. As a growth fund, you can expect this to appreciate more than the overall market with some higher risk. Don't be surprised if this fund performs poorly during a bear market. Comprised of about 270 large-cap companies, technology is its largest allocation, which should come as no surprise. The top 10 holdings are almost all technology companies and include Microsoft, Apple, Amazon, and Facebook, which have all been very profitable during recent times, even during the bear market in early 2020. This is likely due to the evolution of technology and our ever-growing reliance on it. Consumer services, which are companies like Walmart, Home Depot, and McDonald's, financials and industrials also make up a large portion of this fund, so there is enough diversification for those with higher risk tolerance. The dividend yield is less than 1% due to the fact that fast-growing companies choose to reinvest their profits instead of distributing them to shareholders. The expense ratio is just 0.04%. VOO An S&P 500 fund is perhaps the best all-around investment that can complement the portfolio of any age investor, but is best suited for the middle-aged in their 30s and 40s and even 50s who decide it's best to assume an average amount of risk. VOO, which is a Vanguard fund, holds the 500 or so companies that make up the S&P 500. This includes U.S. companies such as Johnson & Johnson, Microsoft, Visa, and Procter & Gamble. One of the biggest advantages to this fund is that it provides instant diversification across many sectors, such as technology, healthcare, financials, consumer discretionaries, and more. Furthermore, not just any company can be selected to be a part of the S&P 500. It must meet certain size, health, value, and profitability requirements, ensuring each holding is likely to be profitable for its investors. These are some of the reasons why this is Warren Buffett's fund of choice for most people. You can expect an average dividend yield of approximately 2% and an average rate of return, as you're essentially purchasing the market. The expense ratio is 0.03%. DIA Similar to the S&P 500 index, the Dow Jones Industrial Average can also be referred to as the market, and is the best for middle-aged investors with average risk tolerance. While not as broadly diversified, adding this benchmark is still a good option for those middle-aged investors, as the risk associated is average. The SPDR ETF tracks the 30 companies held within the Dow, which is the second oldest U.S. market index designed to be an indicator of the health of the United States economy. Although the industrial name is outdated, as the companies held are from all major sectors with the exclusion of transportation and utilities. Unlike the requirements for the S&P 500, those requirements for the Dow are somewhat vague, but the companies chosen are all very large industry leaders. Examples of the holdings are United Health Group, Home Depot, Boeing, and Visa. As with the S&P 500, the largest sector allocation is technology, which is followed by consumer cyclicals, healthcare, and financials. This ETF also pays a monthly dividend, which can allow those payments to be reinvested faster. The yield is above 2%, and the expense ratio is 0.17%. SPYD SPYD is an S&P 500 high dividend fund offered by SPDR that makes a great choice for older investors in their 50s, 60s, and beyond who require more income and less growth. While the income is high, volatility can also be somewhat high due to its concentration within the sectors. Made up of around 60 different companies, This fund is heavily invested in real estate in addition to financials and utilities. Among the fund's top holdings are Kraft Heinz, AbbVie, Dominion Energy, and Cardinal Health. Most of the holdings are established, mature businesses that's growth has plateaued, so management has decided to pay a remarkable percentage of their income to shareholders. The dividend yield is currently around 6%, and the expense ratio is 0.07%. SPHD. This is one of the best funds for those that are older, in their 50s, 60s, and beyond, who require income to fund their retirement. Offered by Invesco, the S&P 500 High Dividend Low Volatility ETF is an excellent combination of income-producing stocks that are held within the S&P 500, meaning they meet the eligibility requirements. Currently, there are 52 carefully selected least volatile holdings, which include AT&T, General Mills, and Philip Morris. The largest sector held is financials, followed by consumer non-cyclicals, which allows for more stability and less risk. Lower capital appreciation can be expected from these large, older, income-paying companies, but the income received will be higher than average. The dividend yield is currently around 5.5%, and the payments are made monthly, which is a unique aspect, making it very desirable for those living off their dividends. Younger investors who are many years away from retirement and who have years to wait out any volatility will be better off long-term with something else, as the total return from a growth fund is likely to be higher. The expense ratio is 0.3%. VFMV. Another great addition to the older investor's portfolio, Vanguard's U.S. Minimum Volatility ETF provides extra stability to complement any high dividend funds and hedge against risk. The 150 or so holdings are chosen for their ability to perform during questionable economies, which will protect you against extreme price swings. While not a bad choice for younger investors, it's better the closer you get to retirement due to its slower growth. Among the top holdings are Flowers Foods, Verizon, and Electronic Arts, which aren't much affected by economic cycles, so they're going to perform well even when the overall economy doesn't. Technology, healthcare, and financials are the largest sector allocations. Even though in the past technology has been a volatile sector, it's evolved significantly and the economy relies more heavily on those products and services. The dividend yield is about 2.5%, which is higher than average. The expense ratio is 0.13%. Although these mentioned are specific funds, there are almost always alternatives offered by your employer. If you're investing within a 401k and these particular branded funds aren't available, you can simply choose a general growth fund if you're younger, broad market fund for the middle-aged investors, or a high dividend fund for those almost ready to retire. When you're investing many years from retirement, it's important to have your portfolio geared towards higher risk and higher growth if you want to achieve the highest returns. Then, as your retirement date nears, slowly shift those growth funds into an overall market fund such as the Dow or S&P 500. Just before retirement, you can switch those broad market funds to dividend-paying funds that will provide the passive income and cash flow needed to fund everyday expenses. As always, it's critical to assess your financial situation and goals. If a growth fund will provide enough income for you to retire on, you might choose to leave your money there instead, so it can continue to grow to provide excellent returns. Which funds that best suit your portfolio will depend on how large your nest egg is, your needs, and risk tolerance, so it's important to understand how to correctly design your portfolio, as it's different for everyone.